Welcome to this session. So today we'll be focusing on taxation of interest income in Kenya. We want to understand the tax administration with respect to taxation of interest income in Kenya. And so first we need to define for us what interest is. What is this interest? So we'll define interest then as interest payable in any manner in respect of a loan. So if there's a loan which has been advanced and there's interest on it, then it falls under the definition of interest for this purpose. On a deposit, so if there's a deposit and there's interest which is accruing on it, then it falls under the definition. Interest on debt, interest on a claim, interest on other right or obligation, and it also includes premium or discount by way of interest and commitment or service fee paid in respect of any loan or credit or an Islamic finance return. All that then falls under the ambit of interest for purpose of taxation. So what you're saying then again is that interest on tax will not fall under this definition. Interest on tax due will not fall under this definition. So having defined what interest is, so we're saying that income which accrues from a loan, advanced, a deposit, or a debt, or a claim, or a right, or obligation, then all that then should be brought to charge to tax. Then secondly, we need to inform ourselves of the charging section. So this is brought to charge for tax under the Income Tax Act, the charging section, section 3(2)(b). So the charging section then becomes section 3(2)(b), which brings this income to tax. So the next item which we need to discuss after going through the definition and the charging section is the categories of interest income and the consideration and the tax treatment when we are carrying out our tax computation. So first we need to deal with the exempt interest income. What we're saying is the first category is what we refer to exempt interest income, which interest is not subject to tax under section 3(2)(b). And the first category of the exempt interest income is that interest which accrues on bonds issued by East African Development Bank. So that interest which accrues on that bond issued by the East African Development Bank will not attract tax. And the tax in this case is whether withholding tax or the corporation tax. Number two, we're saying interest income accruing from all listed bonds, notes or other similar securities used to raise funds for infrastructure, projects, and assets defined under the Green Bond Standards and Guidelines and other social services. So interest income from those listed bonds, notes, or other securities used to raise funds for infrastructure, projects, and assets defined under the Green Bonds Standards and Guidelines will not be brought to charge for tax. Number three, exempted interest is deemed interest in respect of an interest-free loan advanced to a company undertaking manufacture of human vaccines. So the deemed interest, so in this case, deemed interest is where the commissioner then comes up with an interest to be charged on free loans, on interest-free loans. So in this case, we'll apply the 91-day treasury bill rate to it. But what we're saying for this case, if that loan was advanced to a company undertaking manufacture of human vaccines, then that interest will be exempt from taxation. The other exempt interest income is interest paid to a person, to a resident person or non-resident person by a company undertaking the manufacture of human vaccines. So any income from that undertaking to manufacture human vaccines that interest income is exempt. Then another one is interest paid by a special economic zone developer, operator, or enterprise in the first 10 years of its establishment to a non-resident person. That interest is then will be taken to be exempt. So what we're saying, this category, this exempt interest income, then will not be subject to any interest, any tax in Kenya. So the second category which we'll deal with is what we refer to as qualifying interest income. So qualifying interest income basically is that interest receivable by a resident individual, and this includes even interest income received jointly by a husband and wife. That will fall under the category of qualifying interest income. What it implies is that the withholding tax, which was deducted at source, then becomes final tax. Withholding tax, which was deducted at source, then becomes the final tax, and hence, in the hands of the recipient, this interest income will no longer be subjected to further tax. So the 15% withholding tax, which is applicable at source, then becomes the final tax, and no further tax will be assessed on that interest income in the hands of the recipient. Then finally, the last category is what we refer to as non-qualifying interest income. So this non-qualifying interest income is any other interest income other than what falls under the first category and the second category we discussed. Basically, we're saying interest income which is not exempt, and interest income to and it's not interest income earned by individuals, meaning interest income earned by non-individuals then becomes non-qualifying. And what it implies is that this interest income will be subject to withholding tax at source, and it will be subjected to further tax in the hands of the recipient. Meaning, in the hands of the recipient, it has to be assessed for tax at the rate of 30%, and a deduction of withholding tax credit be made, so that then the balance of the corporation tax rate less net of the withholding tax rate will have to be accounted for in the hands of the recipient. So in summary, we are saying the non-qualifying interest income will be subjected to further tax in the hands of the recipient, further to the withholding tax which had been subjected at source. So taking a case for a resident where the withholding tax rate on the interest income is 15%, then in the hands of the recipient, these non-individuals, the corporates, that interest income has to be subjected to taxes as a specified source of income, a separate source of income, at the rate of 30%. This is apart from income received by financial institutions. So for non-financial institutions, the interest income is subject to 30% corporation tax rate as a specified source of income, and then a deduction of the withholding tax which was deducted at source at 15%, and the balance of 15% has to be paid by the receiver. So thank you for watching, and subscribe to this channel so that then you can receive more videos like this. Thank you.